On Market Call today, our guest is Brian Madden, Chief Investment Officer at First Avenue Investment Counsel. And he's taking your questions on North American stocks. Call us toll-free, 1-855-326-6266, or email us at marketcall@bnnbloomberg.ca. Brian, it's great to see you.
Good to be back, Andrew.
Hard to know where to begin. I mean, in this tariff-shifting swamp, we just don't know where we're going to end up.
Right. I mean, there's a lot of the macro uncertainty has been melting away, obviously in fits and starts over the last couple months, and then more quickly in the last few weeks.
The uncertainty has been melting away.
It is. You know, you've got various countries coming to the table and coming to terms with the United States on the trade and tariff matters. You know, substantively or performatively, you know, we'll let viewers be the judge of what's actually happening, but the market is taking it as a good sign, or at a minimum is making probably the correct assumption that the worst case scenarios that they were pricing in mid-April are off the table. So, you know, hence we have stock markets in Canada and the United States hitting all-time highs.
What is your basic strategy now? I mean, I guess one big question is, do I pile into the big Mag 7 stocks? Are you still in those, market weight, for example?
No, I would say broadly we're below the market weight of the Mag 7, and you know, just for context, their market weight is massive.
Yeah, that's true, of course.
You know, that would entail having, if you were running just a U.S. equity mandate, which we don't, we run North American mandates, but if it was just a U.S. equity mandate, you know, that would entail having about 33% of your portfolio in 7 stocks. So to us, that's sort of imprudent and an undue amount of concentration. So, you know, being active managers and judicious stock pickers, we own a couple of them and we pick our spots, and the ones we don't like, we don't own.
And later on, you are going to have a tech idea for us that is a crucial vendor into these data centers and huge cloud providers.
Yeah, exactly. So not to spoil the suspense, but, you know, I guess the old adage, selling picks and shovels to the miners, or in other words, being upstream of the poster children for the AI arms race is a worthy investment approach, and so we have an idea in that vein to talk about a little later on.
Do you think the market, is there euphoria in the markets or excessive exuberance with stocks at record highs?
You know, increasingly there are signs of that. I would point to 2 things in particular that would be telling of, you know, maybe complacency or a bit of greed over fear imbalance, and those would be the resurgence in the meme stock trade. So your Open Doors and the like are becoming rock star, you know, massive heavy volume traders in the retail and in some cases the institutional crowd, just as they did in 2021, yet again. And then the other one would be leverage. So the New York Stock Exchange members extend margin credit to clients of their member firms. And so, you know, we're seeing data suggesting that margin debt outstanding has surpassed $1 trillion. So that's quite a lot. You know, a few years back it was $500 or $600 billion. Also a big number, but it's just sort of the scale of the advance that tells you, you know, people are getting increasingly comfortable with the durability of the economic cycle and the stock market rally, and we are too. But there's a lot of ground between being comfortable with the durability of an economic expansion and piling headlong into things like meme stocks and zero-day to expiry options and triple levered ETFs and the like.
We've got to take a break, but we're going to be back with Brian Madden taking your questions on North American stocks. And there's that number, 1-855-326-6266. Let's kick off here with an email from Len. Can your guest please comment on Superior Plus? I'm a long-time holder, and I think that means well ahead with dividends earned over the years. Wondering if it's time to sell. It seems to be rudderless.
Yeah, thank you for the question, Len. So for those that don't know, Superior Plus is a propane distributor in Canada and the United States. I believe now about 2/3 of the business is actually south of the border in the eastern U.S., Midwest, and in California. And then broadly retail and wholesale propane distribution in Canada. More recently, they made an acquisition in 2023, may have closed in 2024, of an entity called Certarus, which gets them into compressed natural gas and renewable natural gas. So I think the belief is that propane is mature, but some of these alternative forms of energy, and I should say also hydrogen, maybe emerging kind of growth areas. This is not a stock that we own. It's not a stock we'd be buying, and our counsel too would be to sell it on a rally. It plunged quite substantially. It's got pretty erratic earnings. It does pay a dividend. The yield is about 2.5%. However, they did cut the dividend 75% a couple of years ago. And so the long and the short of it is you're essentially trading income for capital here. And so to back that up, I would point to the fact that the compounded total shareholder return over a decade is about just over 1%, and over 20 years it's about 0.5%. And that's because this company does not typically earn its cost of capital, and it's got a fairly erratic earnings pattern. So, you can trade it, but in our view, it's not a very compelling long-term investment. So on a rally of $1 or $2, I would say it's time for sayonara for this one.
We have an email from Dana. Can I get your opinion on Aecon? Is it a good hold, or would you recommend an alternative in that space?
Yeah, thank you for that question, Dana. We do have a better idea. I will say, this one, if you own it, it's probably not the end of the world. It's yielding about 4%. It grows its dividend about 6% a year, or has over the last decade. It trades at a discount to other construction peers, at pretty steep discounts, because it's less profitable and less growthy. In terms of earnings, it's trading at about 16 times earnings. The peers are at something closer to 22. And on enterprise value to EBITDA, similarly discounted. One interesting thing about Aecon that is a little bit differentiated from some of the other construction and engineering and general contracting firms is they have a smaller segment that they call concessions, where they sort of take partnership stakes as owner-operator in infrastructure investments. So in the past, they'd owned stakes in airports and things like that, or toll roads. One of the interesting things from a Canadian perspective that they're working on right now, which is coming to fruition and it should be ribbon cutting in September, and hockey fans take note, is the Gordie Howe International Bridge, twinning the border points with the Ambassador Bridge between Windsor and Detroit. So that will come to fruition. But this one, it's okay to hold. But as for the better idea that we think will do much better and has performed about 3 times better, with about a 23% compounded total shareholder return over the last decade, is WSP Global. It's bigger, it's more global, and it's in better verticals. So that's the one that we like in that space.
WSP Global. Let me just look at maybe we could just have a quick look at a 5-year chart on that one. And that's interesting. Yeah. Is it partly their bigger international presence that draws you to WSP Global?
It's the sector balance. They're in water and environmental and remediation, things that sort of have a faster growth curve. But also, yes, they are bigger internationally. And also, they're a serial acquirer and are consolidating what is a fairly fragmented space in this engineering, construction, consulting world.
Thanks, Control Room. There's a look at the 5-year chart. And wow, this stock up more than 3-fold in the past 5 years. Let's head to Milford, Ontario, in beautiful Prince Edward County. Go ahead, John, please.
Thank you very much. I'd like your thoughts on TD Bank going forward. I notice it's the cheapest PE of them all. I own them all, and I'd like to add to it. And Andrew, hope to see you at the Milford Fair.
I'm so looking for, and my dogs, I'll be entering my dogs. It was a disgrace last year when they didn't win. Anyway, carry on, please.
I'm sure they'd get my votes.
Thank you.
Thank you for the question, John. So we do own TD Bank. I've owned it for a number of years. I will say, along with many other shareholders, we were grinding our teeth in frustration over their missteps in the United States, circa 2022 and 3 and front half of 2024. Recently, we have lightened up our weighting in this bank, and it has sort of fallen in our pecking order of preference among the 3 Canadian Big Six banks that we own, just on the re-rating. It's trading at almost parity, a slight discount to its Big Six bank peers, whereas it had been at a high single-digit or low double-digit discount towards the end of last year, and frankly for much of last year as they were under the dark regulatory clouds. But of course, they put that behind them with the epic $3 billion settlement with the U.S. authorities. They're incurring a lot of expenses to step up their anti-money laundering and compliance regimen in the United States. That's going to persist for a long time. Big question is, how long are they going to be in the penalty box and subject to the consent decree that they agreed to? I just met with the management of Wells Fargo yesterday in Toronto. They were in the penalty box for 7 years. So our hope and our expectation is that TD is going to be faster to get out from under that consent decree. However, we still think that they should be able to reach maybe the bottom end of their prior medium-term earnings growth guidance, somewhere around 7%. But they're going to have to pull other levers rather than growing their balance sheet in the United States, tightening their belt in Canada, growing as they have been successfully in capital markets and in wealth management. So there could be acquisitions there, or just getting after organic growth opportunities and getting their elbows up, as we nowadays like to say, and competing more fiercely in the markets that they're in. So we continue to like and own it. I'm going to attend their investor day in late September, and we'll hear a more fulsome plan from their fairly new CEO about what they're going to do to get their mojo back. The market is largely giving them credit for, yes, they'll be able to do it. And that's why we've reduced our weighting in it, but we still like and consider it a core holding.
I'm going to be back with Brian Madden, and Brian is taking your questions on North American equities. 1-855-326-6266. Tony is calling from Prince George, BC. Go ahead, Tony, please.
Hi, Brian. Thanks for taking my call. I hold Alamos Gold, and since its last earnings report, it seems to be underperforming versus its peers. Are you still holding this company in your portfolio? And if so, what is your outlook?
That's interesting, because this was a darling for so long, Alamos.
Yeah, that's right. Thank you for the question, Tony. Yeah, this has been a great performer. It has moved up from a small cap, sort of 1 or 2 mine company, to something that's a little bit bigger and more diversified. It's got a market capitalization now that all but ensures that generalists need to look at it and have a view on it. And you can't say that of some of the smaller mining companies. So we continue to like and own it, acknowledge that there was some disappointment after the release of their Q1 results. We're going to be seeing their Q2 results in due course. Essentially, what we like about it is they've got a good portfolio of mines, the Mulatos mine in Mexico, Island, and forgetting the name of the one that's sort of basically adjacent to it in northern Ontario, and I think there's another one in the mix. And they made an acquisition last year that's going to be quite synergistic. They're going to be able to combine the milling of the ore from 2 mines that are in close proximity to one another at a central mill, so that saves them capital costs and likely operating costs as well. Just on the basis of their current portfolio of mines, they've got a pretty good organic growth profile in production that should, we think, take them out to 2030, growing at a pace, production that is, that should surpass substantially all of the majors and most, if not all, of these sort of mid-cap, mid-tier producers as well. Crucially, their mines are in jurisdictions where you're not particularly at risk of having the rug ripped out from under you, as people like Barrick are finding out the hard way, in Mali, And as folks like First Quantum found out with their big copper mine in Panama getting the permit pulled. So, long game here. This is a company that we think is sort of aspiring to be an emerging Agnico Eagle, which is a much bigger company. And we think that either organically or perhaps via a merger approach from a larger player that likes the portfolio of assets and the organic growth profile, we're likely to get paid one way or another. And we're feeling pretty good about how the Q2 numbers should roll in. A lot of the cost pressures that hit them in Q1 were sort of timing issues that we think will reverse in the second quarter and the back half of the year.
Looks like we're expecting AGI's report on Wednesday of next week, July 30th. So I always get this wrong when I try to do it in my head. The weekend is the 26th, 27th. 28th, 29th, 30th. Yeah, so Wednesday is July 30th. We'll get their numbers.
Yeah, I mean, there's an absolute flood of earnings reports coming in from all sectors, not to mention macro news and policy news next week. It'll be a busy week next week. Yeah,
and sorry, Brian, is there any particular reason why the stock has been weak lately?
We think it's sort of technical as much as anything. It's consolidating recent gains. Gold hasn't broken out to fresh new highs, although it looks like it's on the doorstep potentially. So, these are good opportunities to add incrementally to existing positions in our view.
And people over 5 years, they've had a return of 150% from Alamos Gold. And let me just check very quickly what the gold index has given people. It's been more like only 50%. So it's been 3 times the return over 5 years compared to the gold index.
Yeah, you really need to pick your spots in gold mining in particular, but really all of the resource and extractive industries. They're notorious for making poor capital allocation decisions. This is not such a company. It's a good capital allocator.
Let's go to George in London, Ontario. Go ahead, George, please.
Yes, thank you for taking my call. Brian, I'd like your opinion on Choice Properties. It's vacant land abutting all the Loblaws stores as well as other retail outlets, and whether they have options on other lands around them, and whether there's future development or what will happen to it. And I don't know even what they pay in dividends, but I've held it for some years.
Yeah, great. Thank you for the question, George. So yeah, as you noted, this is an entity that was created via some financial engineering, effectively by Loblaw about 14 years ago, where they opted to spin out the real estate under their stores and create Choice Properties. So mostly the large majority of the rent collected by this real estate investment trust is from Loblaw, so it's a related company in effect. It's not a company that we own, and that's not because we don't like real estate, and it's not because we don't like Loblaw. In fact, we like them both. But in real estate, we have better ideas, and we like Loblaw so much that we own it outright for exposure to the operating business, which has operating leverage. And in real estate, we're invested in an office REIT, Allied Properties in particular. And so, and that one is sort of a contrarian play because the office sector, as viewers will know, experienced a very sharp downturn with COVID. Vacancy skyrocketed, which put some financial pressure on office REITs, and consequently they got down to very distressed valuations. And so we stepped into Allied in the fall of last year on the basis of it being unduly discounted to its net asset value. We don't think that's the case for Choice REIT. However, if you own it and you're content with collecting the dividend, and I think your question sort of embedded, do they pay a distribution? They do. All real estate investment trusts are compelled by tax law to distribute all of their income to their unit holders. So it does pay either a monthly or quarterly distribution. So, it's okay, but we have better ideas both in real estate and in grocery.
A yield of about 5.3% right now, apparently. I think we can squeeze in one more caller before the break. Jacob in Toronto, go ahead, please.
Hello, yes. Good afternoon.
Hi there.
Good afternoon. I just want to ask your guest, please, know the name, but
Brookfield. Brookfield Corporation? Sorry. Go.
Yes, if I don't know. I wanted to ask him if it's probably to buy Brookfield Management or Brookfield Corporation. Thank you very much.
Right. Would you have a preference between Brookfield Asset Management and Brookfield Corp?
So we ourselves own Brookfield Corp, although acknowledge that ever since it was spun out, Brookfield Asset Management has been a sensational performer through the long haul, and Brookfield Corp has a very long trading history. It's been a tremendous compounder of wealth for shareholders, and it's basically the mothership. It gets you exposure to all of their various streams of fee income and proprietary ownership in the alternative space, be it renewable energy, or infrastructure, or real estate, or private equity, or credit, or insurance and wealth solutions. So that's our preferred way to get exposure to the Brookfield Group. But Brookfield Asset Management has had a meaningful re-rating, some of which we think may be stemming from their decision, perhaps a controversial decision, but one that we understand the rationale for, to re-domicile to the United States in order to qualify for inclusion in the large U.S. indices, which in turn prompts, what we call the machine of money flows, passive ETFs buying the shares. So that's probably a one-time step function re-rating. Not to say that Brookfield Asset Management, BAM, the ticker, won't continue to perform well. We think it will, but it is not likely to outpace the mothership or Brookfield Corp to the same extent that it has over the last number of years. And it's not particularly evident on that chart, but you see it more so over 2 or 3 years.
Okay. When we come back, we will check out. Oh, there's a look there. Yeah. We saw very briefly a chart over a longer period. When we come back, we'll check out Brian Madden's past picks. Brian was on our show. I was just checking some data on one of his past picks there. Brian was on our show July 22nd of last year, and his first idea has worked out just fine. Cameco, the uranium giant.
Yeah, actually, we first bought this around this time in 2022, somewhere in the 30s, and so we've owned it for quite a long time. And the original ingoing thesis was predicated on the belief that there was going to be a nuclear energy renaissance. And then the rocket fuel, or the turbocharged, the idea was the Russian invasion of Ukraine, which really tightened up supply in the market for both uranium, raw uranium, and enrichment capacity, a lot of which is in Russia. And of course, the sanctions imposed upon that country caused the uranium price to skyrocket, advantaging Cameco and prompting their decision to restart their McArthur River mine, a huge producing mine that had been mothballed or on care and maintenance for a number of years due to low commodity prices. So it sort of was firing on one cylinder, and then now it's firing on two with the also very big and prolific Cigar Lake mine in Saskatchewan producing steadily. Beyond that, they have a joint venture with Kazatomprom, which is the Kazakh state-owned mining company. It's at an in-situ leaching uranium mine in Kazakhstan called Inkai. That has been a bit of fits and starts. So they pick up an equity income there, and they get a dividend from them once a year, and they get a shipment of uranium, which then they ship or enrich. And so originally it was plagued with some transportation logistics because you couldn't transship the uranium through Russian ports, and they had to ship it the long way around, which caused delays. And now, more recently, there are shortages of sulfuric acid in Kazakhstan, and the government has sort of tightened the screws on some of the mining companies with leases there and have increased the royalties. So fortunately, that is a smaller piece of the puzzle overall. The big story is they have 450 pounds of uranium in the ground, low-cost, long-life reserves in Saskatchewan at a time when more and more reactors are needed. And you're seeing almost daily deals between hyperscalers wanting clean energy, but always on, not intermittent like renewable energy to fire up data centers. So uranium prices are firm. We still don't think at a high enough level to stimulate new supply, which the market is going to need over the coming decade. Beyond that, they bought Westinghouse, so that's a 50-50 joint venture with Brookfield Renewable. Westinghouse has signed a few new deals and increased their EBITDA guidance quite materially just in the last month. So that's driven the latest leg higher in Cameco shares. But really, big picture, this used to be sort of a niche mining stock with no good comparables. Now, increasingly, we think it's finding its way into ESG and responsible investing portfolios as part of the green, clean energy solution. So although it's done very well over 3 years, we continue to like and own it here.
Let's have a look at your next idea. Roper Technologies, a provider, diversified provider of software, specialized software to different industries.
Yeah, a good way of thinking of this, viewers might be more familiar with Constellation Software, a real Canadian darling, a consolidator of the vertical market software space. That's what Roper is, essentially, but a U.S. version of it. The difference is they buy much bigger companies. So Constellation buys sort of mom and pops, founder-led companies. Roper usually is sort of doing the secondary transaction, buying from a prior private equity owner and putting it into their portfolio of companies. They just announced the results early this week or late last week. Results were pretty good, and concurrently announced a deal, $1.6 billion deal in size to acquire a company whose name escapes me, but this is the beauty of vertical market software. They're lightly contested spaces. Would you believe a $1.6 billion entity was acquired that is basically the sole competitor in the market for churches and faith-based organizations, enterprise management software.
I see they do that for 20,000 churches. They serve.
So there's great blue skies in front of them, but this is sort of just a great example of the kinds of deals that they do, and and it's a very fragmented space. So although the shares have been trading mostly sideways, it's been a very good long-term compounder. We expect it will continue to be, although it's difficult for it to compete with the megawattage star power of the Mag 7 when the market's in go growth mode as it has been.
Yeah, so they bought this company called Subsplash that serves thousands of churches and ministries. Finally, we're tight for time. Canadian National Railway, the market not in love with that stock right now.
No, so fortunately we sold this stock in September. This one wasn't working out. We got out of it around $156. It's continued to trade lower. So although the pick didn't work out, the sell was timely and avoided a deeper drawdown. But effectively what's happening here is we've been in a freight recession for 3 years, which is probably the longest one anyone can ever remember seeing. It's frustrating the truckers, it's frustrating the rails, and CN kind of came out with a mixed quarter themselves earlier this week, so we're glad to have moved on from this one.
We are going to take a break. We'll come back with Brian Madden taking your questions on North American stocks. Claire is calling from Edmonton. Go ahead, please.
Good morning. I'd like Brian's thoughts on Bombardier, please.
Thank you very much.
Okay.
Great, thanks for the question, Claire. Bombardier is a company that we bought, I guess, about 14 or 15 months ago after attending their investor day in Toronto at their new facility up near Pearson Airport. Obviously, we're quite pleased with how the shares have performed. We continue to like and own it. The big run-up in the shares in the last month is on the back of them announcing a contract to deliver 50 aircraft. So to put that in context, their production plans call for 160 planes to be produced this year. So 50 is a big contract to win. I believe the name of the customer was not disclosed, but at that size, it's clearly one of the fractional jet fleet companies. No individual needs 50 private aircraft. But this is not your father or grandfather's Bombardier, and this is what my colleagues and I like to call a long memory stock. And by that I mean the earth was scorched by generations of prior directors and executives who destroyed 99% of the shareholder value from 2000 till the trough in COVID, at which time they had to fire sale off large parts of the company. The majority of it, in fact, sold the rail business to Alstom and the commercial aviation business to Airbus, and had long before hived off the jet ski and skidoo business, which is now publicly traded. So what you're left with is a pure play on private aviation. Simply put, we think they're a generation to a half a generation ahead of their other competitors, and there's only two of them really that matter in the medium and long range aircraft. And simply put, the Challenger and the Global Express jets are pound for pound the best planes on the market. And when you're selling $40-ish million aircraft, in the case of the Challenger, $70-80 million aircraft in the case of the Global Express, to the 1% of the 1%, it's not a comparison shopping exercise. It's a money is no object exercise, and you want the best jet, the fastest, the longest range, the quietest, the lowest emissions, best comfort, and so on. And Bombardier has that. Beyond that, nice kicker is they're getting more market share in their aftermarket parts and service business, which they're unlocking via opening new service centers strategically in different corners of the world. And then finally, icing on the cake is there's opportunity to win some defense contracts because defense spending, as we know, is on the upswing in Canada and across all the NATO allies. And they can repurpose these aircraft on the same chassis and airframes for use in surveillance and command and control and reconnaissance missions. So this stock is enjoying a nice moment in the sun after 20 years under a dark cloud that ended 5 years ago. And most investors have not dusted off the file and waken up to take a fresh look at it. So we think there's still more upside.
We've got Dave calling from St. Catharines, Ontario. Go ahead, Dave.
Hi, thank you for taking my call, Andy. Brian, I'd like to ask you on Royal Bank, where you see it going in the next year or couple of years, and is it a good stock to own? Thank you.
Thank you, Dave. Short answer to that question is we own it. We've owned it for a long time. We think it's the best Canadian bank. I dare say, you might call it the JP Morgan of Canada. We used to talk about a big six group of banks. We used to talk about the money center banks in the United States. JP Morgan has differentiated themselves from those peers, and it's in a crowd of one. We think the same is becoming increasingly true for Royal Bank. So we like it, we own it, we think it's going higher. And that's predicated on its dominant personal and commercial franchise in Canada. The business in the United States is not as good as the Canadian franchise, but it's turned the corner with an executive team shakeup a couple of years ago after some troubles there, and competes reasonably well. They have the biggest wealth management franchise in Canada, operating under a number of banners. And they have a globally top 10 capital markets business that we think is going to grow nicely and perhaps benefit from the unlocking of some pent-up capital raising and merger and acquisition activity if, as we expect, some of this macro and policy uncertainty gets behind us and into the rearview mirror stateside and globally. So any day that ends in Y is a good day to own the Royal Bank.
Okay, thanks for that question, Dave. Amin is calling from Ottawa. Fire ahead, Amin, please.
Hi, gentlemen.
Hello.
I'm invested in dividend-paying large-cap stocks, U.S. I have JP Morgan, I have Citigroup. I want to sell Wells Fargo, and I'm looking for a large-cap dividend-paying stock, which is down right now.
Thank you.
Thank you. So I'm going to sort of pick at the premise of the question. So, not to get too deep in the weeds by way of background, but one of the core disciplines we practice at First Avenue Investment Counsel is dividend growth. So it would seem that is part of your investment philosophy as well, owning dividend payers. One of the other disciplines, a different portfolio managed by my colleague Ian Chong, is momentum. So generally in that mandate, we don't buy a stock just because it's down. And in general, that's not a great reason to buy a stock. So you could find a stock that pays a dividend that's down, but there's no indication that that is a necessary precondition for success. What I would suggest, if your choice is between Wells Fargo, and I should note I met with their executive team yesterday, and to their credit, they've finally gotten out from under the regulatory overhang and had their asset cap lifted by the regulators in the U.S. a couple of months ago. So that debottleneck some of the growth opportunities for them. However, nevertheless, there's certainly a quality differential in our mind between that bank and JP Morgan. And so if you're looking for a switch, although JP Morgan is not down, in fact, it's at an all-time high today, along with the whole stock market. And that's what good companies do. They make fresh all-time highs, not every day, but over time. You want to buy stocks high. Buy low, sell high has done a great disservice to a lot of investors. We think a good mantra for people to put in the back of their mind is buy high, sell higher. That's what we're doing with JP Morgan, having introduced it into our portfolio around $250 a few months back.
We're going to be back with Brian Madden of First Avenue Investment Counsel. The topic today, North American equities. Okay, let's get to the next caller, Pooja in Oakville, Ontario. Go ahead, Pooja.
Good afternoon, gentlemen. Andy, always a pleasure.
Thank you.
Brian, your thoughts on Tourmaline oil? It seems the energy stocks are currently trading at a discount. Is this a good time to get into the stock, your long-term take on the stock, the tariff impact and so on? The CEO, Mike Gross, is buying a lot of stock back. He's a prolific leader in the sector, so would love to get your thoughts and if this is a good time for me to invest in it. Thanks.
Thanks for the question, Pooja. Simply put, yes, this is a very good time to buy the stock. We ourselves bought it within the last month or so. We had owned it previously. And we're quite happy with the investment, but we had sold it, I think, in early 2024. As you noted, Mike Rose, the CEO there ever since the IPO, previously had led Duvernay Energy before it was sold for $8 billion to Shell Canada. Very good operator. The magic or the secret sauce here is they have what we believe is probably the best drilling inventory in the Montney and the Duvernay basins in British Columbia and Alberta. Many decades of drilling inventory. They're already the largest natural gas producer in Canada. I think they're producing about 3 BCF a day. That's something like 13 or 14% of all the natural gas produced in Canada. Also, crucially and strategically, they own much of their own infrastructure, the midstream natural gas processing and fractionation plants, directly and via an affiliated controlled entity. So that allows them operational flexibility. They're lean operators, keep transportation operational costs low, and also they've been very smart and thoughtful about diversifying their market access away from the AECO basis, which is the cheapest natural gas in the world, and locking in contracts at other delivery points in Washington and California, British Columbia, and even have contracts in place to ship LNG out of the Gulf Coast. And of course, as viewers will know, LNG, sold into Europe is fetching about $12 or so an MCF, and similarly in Asia. So needless to say, that's a lot better than selling it for $1.50 or $2 at the AECO hub. So they've done a great job, and they're smart and shareholder friendly about return of capital to shareholders. When we owned this previously, I think we collected something like $10 a share over about a 1.5 year period when nat gas prices were really high after the Russian invasion of Ukraine, via a combination of regular and special dividends. And as you noted, they also buy back a lot of shares. Last thing, very important, they eat their own cooking. Mike Rose is a very large shareholder of this company, so good shareholder management alignment here.
Okay. Thanks for that question. Jason is in Toronto. Go ahead, Jason, please.
Yeah, Brian, can you give us your thoughts on Alphabet? They just reported recently, and maybe add something about the mega cap tech names, what your thoughts are. Thank you.
Thank you.
Yeah, by all means. So Alphabet, we own it in our Momentum mandate. I've owned it for a while. They reported results a couple of days ago. Good results, beat expectations on sales, earnings, and all the other key performance indicators. The earnings were up about 22%, sales about 15%. Crucially, there was an acceleration in their cloud computing business, which is now at about a $50 billion annual run rate and is probably the fastest growing part of the business. And they also announced their intention to step up their capital spending in an effort to be out in front of this artificial intelligence arms race, from $75 billion to $85 billion. And so you might ask, well, is this a reinvestment cycle or is it a capital return cycle? It's not either or, it's both. They're also buying back or have an authorization to buy back $70 billion worth of their stock this year. So it's very cash generative, undisputed leader in advertising through search and YouTube. And they're getting their fair share of sort of the smarter AI-assisted search, and are trying to get their head around ways to better monetize that. And we think they will. So we like it and continue to own it. Among the other Mag 7 names, the ones that we like and own are Microsoft, again, sort of its dominance in its categories, and NVIDIA for the same reason, its technological superiority on AI spec chips.
Don't go away. Brian Madden will share his top picks after the break. Join us Monday on Market Call. It's Jamie Murray, Portfolio Manager and Head of Research at the Murray Wealth Group, taking your questions on global equities. Let's get to Brian Madden's top picks. You're kicking off here with Telus.
Yes, we are. We think this is the best telecom in Canada. Like the other telcos, pays a dividend. The dividend yield right now is about 7.4%, so that's quite elevated relative to the average 10-year dividend yield that's traded at, which is about 5.3%. But yield alone is not enough. We have a dividend growth mandate, and so not only do we believe that the dividend is secure, we also believe it's going to grow at a faster pace than Canada's other telcos, and that's validated by actions taken by management and the board in November and again in May to cumulatively increase the dividend by 7%. All of the telecoms we think should face easier earnings comparisons in the coming quarters as they lap the cell phone price war that was started about a year and a half ago, to the detriment of the overall industry profit pool. We also think that Telus is advantaged by its financial strength and financial flexibility, while some of its rivals and its operational focus, while some of its rivals are trying to integrate recent acquisitions. Beyond that, it's got an interesting, small but growing collection of faster growing non-telecom businesses, some in healthcare, things like Morneau Chappell, or what used to be called Morneau Chappell, which is benefits and consulting, are rolled up in there. And then we also think there's a few intriguing and unpriced catalysts, like an initiative to monetize some of their surplus urban real estate by redeveloping it into high-rise housing. So these would be the old copper-laden central switching stations, which of course we don't need anymore. And real estate is obviously more value than idle copper. Not to mention the copper itself, they think could be worth upwards of $1 billion. So, just selling it for scrap. So lots of interesting things here, and we don't think are reflected in the share price. So we like this one and continue to own and add to it.
Nutrien, you like the look of this one?
Yeah, we do. This is the world's largest crop nutrient business. It's comprised of 3 upstream segments: mining potash and phosphates and producing nitrogen fertilizers, vertically integrated with a downstream farm supply network of stores, spanning about 2,000 stores, mostly in Canada and the United States, but to some degree also present in South America. And really the catalyst for us in getting interested in this name earlier this year was the belief that the commodity prices for all 3 of the primary crop nutrients had bottomed, and that's supported by slowly but steadily improving prices for the major cash crops grown in Canada and the United States, so things like corn and wheat and soybeans. This is a company that is trading roughly at parity with its longer-term trading multiples, about 1.3 times book value, yielding about 3.6%. But we think that the earnings are on the cusp of a turning point. The company has grown its dividend by 36% since the merger of the 2 predecessor companies, Potash, Corpus Saskatchewan, and Agrium, back in 2018. And also, it's reduced its outstanding shares via normal course issuer bids and share buybacks by 23% over that time frame. So we think it's got a good capital discipline and return of cash to shareholder policy and some nice cyclical exposure poised for a turning point here.
And then your final idea, Arista Networks. So they're a supplier to big data center companies or customers?
Yeah, that's right, Andrew. So Arista Networks is a cloud networking company that sells products and services into data center, campus, and large enterprise environments. So those are primarily Ethernet switches and routers and the software that controls them for monitoring and network detection and that sort of thing. So as we alluded to at the top of the show, this is sort of the idea that plays on that selling the picks and shovels to the miners. So the miners in this case would be the hyperscalers who are splashing out hundreds of billions of dollars to build data centers. And Arista, about 50% of their revenues are derived from some of these hyperscalers. So Meta, Alphabet, Amazon, Microsoft, and so on. So the more capital spending that these cloud titans and hyperscalers are splashing out to edge one another out in this AI compute and data center arms race, the more revenue and the more earnings and cash flow accrue to Arista Networks. Not surprisingly, the market recognizes that. It trades at 40 times earnings. So that is a premium valuation, but it is one that we think is well warranted by the expected 17% compounded growth rate in earnings over the coming 3 years. And that is all underpinned by the very, very, very strong secular growth prospects for data centers and AI computing.
Oh, down to the wire. Thank you very much indeed, Brian.
Pleasure. Great to be here, Andrew.
Brian Madden has been our guest. Remember, Jamie Murray is coming up on Market Call on Monday. He'll be talking global equities. Have a wonderful weekend, one and all.